Investing tips from Mohnish Pabrai, the author of The Dondo Investor.
In investing, we never swing for the fences. Or in British terms, we don't go for hitting sixers. Okay? We try to get, one run here and one run there. That's what we're trying to do. I think the first question to ask when you look at a business is it within your circle of competence? Is it something you understand well? When you identify and find these exceptional great businesses, which have very high returns on equity, very long runways, very great managers, very deep moats, you go all in. And ideally, you try to find them small, and then it's set it and forget it. And it's similar to what this book in 1972 came out, talks about the 100 to 1 in stock market returns. I think even though the book is 48 years old, I think it's timeless. So I think these were the big lessons for me, which is I was always an investor who said, okay, find an undervalued asset and sell it at full price. Like, for example, when I bought our investment in Turkey, I said, okay, this is very undervalued. We have a good run. At some point, we'll move on. I don't think about it that way anymore. We own 1/3 of that business, which means that out of the 12 million square feet, 4 million square feet belongs to us, my fund investors. I like that business. The managers are really good. And we will keep that business for a long time. And so that's a completely different mindset from what I had before when I was trying to do these precise calculations of intrinsic value and all of that. We're not doing that. So that's the big change. My model is that as long as the business is improving and as long as the trajectory of the business is that it's, over the longer term increasing in valuation and getting better, we'll keep owning the business. And it could be 10 years, 20 years, 30 years. I don't know how long you hold it. If you don't know what you're doing, please index. Pretty honorable way to go through life, and you still get the power of compounding. But if you know what you're doing, then it seems like insanity to own 30 stocks or even 20 stocks. I mean, why would you put money, Buffett would say, why would you put money into your 27th best idea instead of your third best idea? So that just makes no sense. And the idea that you would actually understand 27 businesses as well as each of them or equally is unlikely. From my point of view, the answer has been, at least in Pabrai funds, has been to go with like a 10 by 10 portfolio, 10 stocks, 10% each seems like a good medium. In my personal portfolio, sometimes I've had one stock, and sometimes, and I don't think I've had many occasions when there have been more than 4 or 5 positions. Growth and value are two sides of the same coin. Just because you buy Amazon doesn't mean it's not a value stock, and because you buy some coal company at 1/5 the book value doesn't mean it's a great value stock. So all businesses are worth the sum of cash flows they would produce over their entire duration, discounted by some reasonable interest rate. So if you're a very rapidly growing business, the cash flows are increasing, so you can pay more for it because you have a growing stream of cash flows. And if you have a declining business or a flat business, that also has a value, but it'll be a different value because those cash flows aren't.
Thank you for listening, and we'll see you on the next video.